Equity markets in India and globally have been in a bit of a tizzy over the past several weeks. It started before the onset of the conflict in Ukraine. In fact, it's something that dates back to the worry about unwinding of easy monetary policy, and there are several other factors also to bear in mind. I'm joined, in fact, by Kirtan Shah, who's the founder of, the co-founder and chief executive officer of Credence Wealth Advisors. Kirtan, you've studied this in some detail, and I'm hoping that our conversation will give people a little bit of context, and then we'll get into how one should deal with the current scenario. But first, if I were to ask you, why has global equities taken the kind of drubbing that it has over the last couple of months? What would you say?
Alex, thanks so much for having me on the show. So Alex, like you rightly put, I think to my mind, whatever we've been seeing happening to the equities market is probably more to do with inflation and interest rate than the war, right? So like you rightly said, even before the war started, 6 months before the war started, I think FIIs have been aggressively selling the Indian markets. And we've really seen the FII favorite stocks like the HDFC Group and so on and so forth being under pressure since a long time before the war started. So ideally, what we really have to understand is that the larger problem of this market is inflation going up and hence interest rate going up as an expectation. And war just kind of extrapolated it slightly more faster than it could originally have been. Right. So to put this in context, I think there was so much of liquidity flushed in the markets, over the last 2 years because of the corona crisis, that the market was injected with, the kind of liquidity that we really saw, which drew the global markets, including the Indian markets up. Before the war struck, we saw inflation in the US being at 40 years high. Even before the war struck, we actually saw the 10-year yield on the US bonds go above 2%. All of these things were very categorically making an assumption or pointing towards growth coming back in the global markets. And hence the kind of liquidity that was made available over the last 2 years, or the low interest rates which were, prevailing, had to come to an end, right? And keeping this in mind, because liquidity was going to be sucked out of the system or interest rates were supposed to go up, markets were already pricing in interest rates to go up. But it's just that this war unfortunately happened, and, you saw the markets reacting aggressively. But I think you probably might end up having a result on the war probably in a week's time or 10 days from today. But the larger context of this market is still going to remain high inflation and hence interest rates going up, Alex.
Kirtan, now this next part of the conversation I think might get a little theoretical, but I think it's important to establish this fact. Now, traditional monetary policy in economies like India and also in the US, there is a balancing act between growth and inflation. And therefore, in order to support growth, you had a lot of liquidity measures that were done. You also had interest rates kept very low. This is something that happened in India as well. Now, what is happening right now, the current context is that inflation, because of supply side issues, has been going up and demand side pressure also. We have elevated inflation, and now this war is coming at a time when we were hoping that growth had come back. So you might see an impact on growth and elevated inflation at the same time, and so therefore a big conundrum for, I think, monetary authorities around the world. How should an investor look at these things, and how do you think things will pan out in the near to medium term?
So Alex, you put this perfectly in the context. We typically in the economical language call it stagflation. What we are trying to see right now, or what we are seeing right now, is inflation was already at an elevated level even before the war happened. Now, because of the war, you've seen supply constraint, logistical problems. You've seen oil go up to as much as $130 or $140 in the near term. And I'll not really be surprised if oil keeps going up if the war does not come to a conclusion. And what is this doing is adding a lot of lot of near-term pressure on inflation, which is already extremely high. Now, look, as a monetary authority or probably as Fed or any other central bank, you know that supply chain has got disrupted. You've got decades high of inflation. And this is really the time that you will have to, suck liquidity out of the system, pump interest rates up. But you are not going to be able to do that so swiftly, is because now what has happened is because of this war, you've seen that probably the global growth that you were envisaging might not happen because of various factors, right? So now if the global growth is not going to happen in the way you were envisaging, right? But yet there is inflation. As a central bank, you are always going to be in a 2020 situation of, do I increase interest rates and by how much? So to give you some analogy, probably everybody before the war happened in the market was anticipating that Fed in March will come up with a 50 base increase in rates, right? But you saw lately Fed coming out with comments that, we are prepared with 25 basis. I'm also open to 50, but I am willing to do a 25. Now, what that has done is, while the market was pricing in a 50 basis hike in March by Fed, now the market knows that the Fed will not be able to do a 50 because there is going to be growth challenges. The Fed will only do 25. Now, the problem really here is stagflation. What I mean by that is that if you do a 25 instead of a 50 that the market was anticipating, you're not really going to be able to control inflation, which is really the monster. So now if inflation persists, and you are slowly going to also increase interest rate, which is also going to add pressure on the growth, which is already going to be hampered by war. Both of these are going to end up negative for the market. Inflation will keep going up, interest rates will go up, unemployment will increase, and at the same time, you will not be able to control inflation, right? This combination, which we call as stagflation, is something that market was not really prepared for, and war has just extrapolated that and made it difficult for central banks. And hence, if stagflation is the way forward or is the direction in which we are moving forward, I think the first thing that investors really need to do is reduce their expectation from 2022. If we are actually moving in this direction of stagflation, Alex, in my opinion, 2022 is not going to be probably a great return generator in terms of what markets were typically expecting, and specifically given by what the market expectation has really been built over the kind of returns that investors have been able to generate over the last 2 years. This is going to be extremely difficult 2022 a year for all of us who expected extremely high returns because of the returns that we've experienced in 2020 and 21. The first suggestion that I really have for investors is pay down your expectation in 2022. It is not going to be a great year in my opinion.
I want to actually come to that now, because that really, I think, is the crux of the conversation. We've set the context, so to speak. But how does the Indian individual investor approach this? Because one has to take tactical decisions here. One thing that has emerged, I think, over the course of the pandemic is the lure of investing in assets abroad, in international equities. Does one pull back on that and say, okay, I'm going to be a little bit more conservative, at least in the near to medium term, till things settle down? And how does the investor broadly approach their investment strategy in the near to medium term?
So Alex, look, some historical data point, I think, to put this in context so that a lot of us understand. If you look at historical data points, you will see that on a 3-year average return, S&P has generated a 4.4, 4.5% kind of returns 3 months before the first rate hike happens. If you look at the last 50 years of data since the 1950 or probably 70 years of data, you will see that 12 out of the 13 times the Fed has increased rates. The US markets have always given positive returns 12 out of 13 times. But this time around, the situation may be slightly different in terms of what we've experienced in the past, because we are not talking about a simple plain rate hike, but we are talking about a stagflation more than only just an inflation. So my first suggestion, very honestly, to everybody who's hearing me talk here, is very simple. First, you have to pare down your expectation with respect to what 2022 can really do for us. Second, very importantly, you will really have to approach this market from a medium-term perspective. In my opinion, those days are gone that we've seen in 2020-21 where, any stock that you bought went up. Things are going to be extremely stock specific now, and near term is going to be extremely volatile. So if any new money has to get invested in the market today has to only come with a 3-year time frame. Anything that you will try and do with a shorter term time frame, trying to ride the volatility may not work in your favor. So follow your asset allocation, come with at least a 3-year view in mind in this market, because you are not going to really be able to make anything significant in less than 3 years of time frame. And also what is very important in my opinion, Alex, that investors really understand that yes, historically, India has participated in probably 6 out of the 13 rate hikes that US has seen. And we've delivered positive returns in 5 out of the 6 rate hikes that we've participated. But the near-term markets are, in my opinion, going to be extremely volatile. And probably, this war may come to an end soon. We may see a relief rally in the markets, but this relief rally, unless we have clarity on whether we are moving on how in terms of inflation and interest rate might get sold into. So please come to this market with a 3-year view. Definitely India is a perspective from a 3-year, 5-year. I don't see a reason why we are not going to end up doing very well as an economy. But if you are going to, kind of come to the market to make quick bucks that you've seen in 2020-21, I don't think that's the right strategy in the market today, Alex.
Well put, Kirtan. And certainly the advice that is coming in is to zoom out and to extend your time horizon. Thank you so much, Kirtan, for taking the time. All right, on that note, we are slipping into a short break, but on the other side, we've got a lot more, so do stay tuned.